Hi, in this lesson, I'll be sharing with you 7 trading mistakes that you probably make and how you can overcome it. Number one of this challenge is trading against the trend. It is always said that the trend is your friend. So you didn't need to make a trend or a trade entry that will make you an enemy of the trend. So it simply means that if the trend is your friend, when you trade against the trend, you are indirectly making yourself an enemy of the trend, and as such, it will result into loss in your trading. So, looking at this trade, you can see that this price presently is on a downtrend. Just as you can see, we are having a series of a lower low, lower high, lower low, lower high. We have lower, lower high. So we are yet to have a break of structure at this point, or a break of our trend line for us to confirm that we are now in an uptrend. So far, and you can imagine we have a resistance here at the moment. We'll need this zone to be broken for us to confirm that we are in an uptrend. So in this type of scenario, you should be looking for opportunity to sell and not opportunity to buy. But in most cases, some of us at times will go ahead seeing this market and then will begin to buy, trading against the trend. So always identify the trend of the market before you make your entry. So in an uptrend, you are not expected to be selling, you are expected to be buying. In a downtrend, you are expected to be selling. What is expected of you in this scenario is for you to carefully pick up your trend line and mark out something like this. Okay, so you are expecting price as it is now. What is your expectation? You are expecting price to break through to the downside, this trend line, so you can make yourself enter. Or price should break out to give us a break of structure, a break of trend line, so we can now go to the upside. So that is what is expected of you in this scenario. Number two, trading without stop loss. Now you must know that there is no guarantee to every trade that you take. No guarantee at all that any trade you take will go in your favor. Every trade is a probability. So the only guarantee you have as a trader is your stop loss. And you must realize that your number one goal as a trader is capital preservation and not profit. Your goal is capital preservation and not profit making. Because if you did not blow your capital and your capital is preserved, you will definitely end up being profitable. So never you trade without stop loss. You are not a market maker. You don't know to the extent market will reach before reversal. So just as this trade, you need to do a click on it and set your stop loss. Your stop loss is always at the low, the previous low. Modify it, your stop loss is set, and you are good to go. So never trade without a stop loss. Then number three is jumping into trade. Jumping into trade is one of the biggest challenge that we face as a trader. Can you imagine this? We've done this analysis in our previous video, and you can see the price is still playing out in this manner. So many a time we just jump into trade for no reason. For instance, just as price is, you just come, immediately you cite this market. You now conclude, oh, ideally, you are supposed to have made your entry at this point. You now say, price has left me, price has left me, without waiting for an entry point. Then immediately you click on your buy trade. You jump into trade, hoping and believing that price have actually left you. Now the truth of the matter remains that there is nothing like price has left you. And even if price leave you, there is always another time and another day where you have setup and you have formation. Okay, entries always reoccur. So you must know that staying out of a trade is also a trading position. You must not always be in a trade. And another way to avoid this particular scenario is for you to have more than one asset on your watch list. You can have GBP USD, AUD JPY as the case may be, okay, NZD card, so that once you miss a particular entry, you can wait for the other entry, but not jumping into trade, feeling that price has left you. It is a very, very bad trading decision. Number 4 is trading moving average cross overbought and oversold region of our RSI or window indicator. I've hammered that so much on this channel that the fact that price just crosses a moving average is not an entry. It is an abuse. It is a system that works, but many have abused this particular pattern over time. So what is the right thing for you to do? For instance, for a moving average cross, like here now you have a moving average cross. Now, before this particular cross happen here, price is already here. You wait for a pullback to your moving average. You can see how that pullback happened to your moving average. Then you connect your trend line. And as you can see, look at what we have. We have a candlestick pattern, and that gives us a break of that trend line, and you can have your entry. So that is the best way you can take advantage of that. And the fact that price is in an overbought and oversold zone is not enough for you to determine that, oh, look at where price is, it's about to reverse, it's an overbought. No, always follow price reaction. Number 5 is the concept of overtrading. Now you must know the number of entries you made did not guarantee the amount of your profit. What it simply means is that you are overtrading. As a scalper, you don't need to take highest more than 10 trades in a day. And if you are a day trader, a swing trader, at least 4 trades, 3 trades in a day is enough for you. And as a swing trader, maybe in a week, you can have like 5 entries. So that is what it is. So the concept of overtrading, it is not ideal. Because what happens most of the time, the little profit you made due to overtrading, you lost it back to the market. Then number 6 is impatience and revenge trading. Impatience and revenge trading. Many of us have become victims of impatience and revenge trading. Now we must know that Forex is not a game of getting rich quick. It's not a Ponzi scheme, as the case may be. So you must avoid impatience trading. To my own terms, I believe that Forex is always taking money from the impatient trader to pay those that are patient. So for you to make entry, always wait. Be patient enough to have a confirmation. Be patient enough for all your trading conditions to be met before you make an entry. For instance, look at this trade that is on my chart now. Remember, this is a downtrend. We are not supposed to have a buy. Price is as a resistance. Look at that entry we made for illustration purpose. You can now see that presently it is in a drawdown. Why? Because we should be looking for opportunity to sell at this zone when we get the confirmation. It is not confirmed for us to buy yet. So impatience can make you to take trade without having adequate confirmations for your trade entry. And the last but not the least is emotion. Most of the time, emotions set into our trade when we begin to make loss. So you must know and accept that loss is normal part of the business. It's a normal part of life. Learn to take your loss. Once you have loss, clear off your head. Take a break, a day, come back the next day. You will find entry. Okay, do not be a trader that don't want to take loss. And some of us, we don't necessarily wait for the right thing to play out. what we do is we trade what is in our heart. We bring our emotion into it. No, you trade your chart. You don't trade what is in your mind. You don't trade your heart. You trade what you see. It is not what you think. The market will not respect that. I believe you have learned something new. I believe that these few tips can help to change your game. It's a game changer for you. And I believe that as you continue, there will be a drastic change. It's a new season for you in your trading. And if you have learned something new, do not forget to like, share, and hope to see you in a subsequent video.